My bond market tip for 2023 is the M&G Emerging Markets Bond Fund. I'm backing emerging market rather than developed market bonds because the starting yields are far higher, and if bond prices rise next year, then emerging market bonds could be some of the biggest winners. The fund is well diversified with around 150 investments, with about 2/3 invested in government bonds and 1/3 in corporate bonds. Currency exposure is evenly split between dollar-denominated and local currency debt. Brazil is its biggest country bet at 4.3% of the portfolio. This fund is paying out about 6.5% in income to investors, but that distribution yield should rise as it adds new, higher-yielding bonds to the portfolio. Emerging market bonds currently yield about 8% when bought on the open market, which is around double the yield of US government bonds. It's been a poor 2022 for emerging market bonds, but that means that the yields are now higher. A high starting yield becomes a big component of total returns looking forward. Another good thing for emerging market bonds is that their central banks are actually ahead of the curve in getting control of inflation. They have been increasing interest rates since last year, which means they have moved quicker than developed market central banks and could therefore cut interest rates sooner as well, which would boost bond prices. Claudia Kalic, who manages this M&G fund, says that despite high inflation in emerging markets, local currency bonds yield more than the local inflation rate, which is not the case in most developed markets. She also notes that many emerging market currencies are still looking cheap, particularly after the strong run for the US dollar this year. If their currencies strengthen, then the income paid to investors when converted back into sterling will be greater.